Federal Reserve Bank of San Francisco President Mary Daly says it's possible for policymakers to hold rates steady. Speaking at an event at the Economic Club of New York, Daly said recent bond market tightening could have a similar impact as a rate hike, giving policymakers more room to stand pat. She talked about what else Fed officials might consider as the inflation fight continues with Bloomberg Surveillance co-host Lisa Abramowicz. Let's listen in as they discuss what the Fed's plan looks like heading into the end of this year.
In the June Summary of Economic Projections, there were 2 more rate hikes projected for this year. Then in July, we took one of those rate hikes, and another one in the September SEP was the median outlook. But the bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there. So from my own perspective, that's what I look at. That my job as I see it, our job as I see it, is not to tighten, just do our part. It's to watch financial conditions, because monetary policy works. We raise the funds rate and it moves through all the other interest rates. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Yeah,
does that make sense?
Absolutely. And Rich Clarida said today that the rise in yields actually does the Fed's job for it. Would you agree with that? Would you sympathize with that kind of sentiment?
That is actually how it works, right? If financial conditions tighten, I mean, one of the things that's happened in the last 90 days and certainly in the last few weeks is that financial markets have collectively seemed to take on board a variety of things. But one of the things that I heard from many commentators and many of the market outreach I do is that they have a general understanding now that we are committed at the FOMC to keeping rates higher for longer in an effort to bring inflation fully back down to 2%. And that recognition, along with all the other factors we could put in a list about why bond yields have risen, are affecting certainly the financial conditions and the tightening. And I see that as a positive outcome, that we would have tighter financial conditions, because then we can really get the job done of putting inflation back to rest.
When is a sell-off something that's welcome from a perspective of finally the market is coming to terms with what the Fed has been saying? And when is it disorderly, disruptive on a level that causes concern?
So you always want an orderly repricing over a disorderly repricing. And so far, what I see is this, and this is why we watch it so carefully, but here's how I'm seeing it, is that what is happening is financial markets are actually trying to find their footing and the right price for things. And they've got to digest a lot of information. One is the supply and demand changes in the treasury space, right? So supply is going up and demand is going down, especially from foreign buyers. So that is one factor to digest. Another factor to digest is Fed policy and forward guidance in the SEP. A third factor to digest is this increasing conversation people are having about whether the real neutral rate of interest is actually risen. So we came into the pandemic or with it at about 0.5, which means nominal neutral about 2.5. And when people say, oh, the neutral rate might have risen for a variety of factors, I'm hearing everything from maybe it's 5 to something that I would see more likely, which is between 2.5 and 3 for the nominal neutral. Probably we don't know if it's risen. Frankly, I don't think anybody really knows, but certainly we should have those conversations. But then markets try to price that in. So all of those factors, and then there's lots of uncertainty in the economy and geopolitical risk and our own fiscal risk. And so that's what markets do. They digest a lot of information and try to find their footing on it. And I think that's what we're seeing. But so far, it hasn't spilled over into disorderly. So far, even today, when the jobs claims came up and it was sort of, I don't know what to make of it, right? So that's what the markets sort of read it. You didn't see things shaking up in a wild or disorderly fashion. So far, so good.
Your bond quote of the day, 470 on the 10-year. I just checked. So it seems like yields are coming in as we speak, just to your point about it not being disorderly. Back in March, when there was this concern about the banking situation, yields were at the low of March, were about 150 basis points lower than where they are now. Are you seeing the same type of financial distress today that you did back then, even on the peripheries? How do you rationalize why it hasn't materialized in the same kind of way?
So March was a unique situation, and we want to learn from that unique situation. But it was a unique situation in this way. We had a bank run, a very old-fashioned but true bank run, where the bank's liquidity was completely squeezed and it dissolved in a period that was it was short, rapid period of dissolution. And then that spilled over to 2 other banks. And that was the extent. Now, one of the things I always remind people of is we have over 4,000 banks in the country and 3 failed. And all other banks that even felt the stresses, and there were a large number that felt stresses because they were near neighbors in sort of size and balance sheet distribution, composition. They felt stresses, but they managed those stresses because in part they had been a little more effective at hedging their risks. And then the Fed and with the Treasury support came in with the BTFP, and that produced a lot of calmness in the water. So since that time, banking stresses have really not been something that when you ask people in the community or the business leaders, what are you just top of your worries? That is not something they list. They list inflation, uncertainty, et cetera. So I think one of the reasons that we are seeing this yield rising, not spilling back over, is that essentially we know what's going on in the banking sector. Investor letters have been published for months saying, here's what this balance sheet looks like. Here's what this balance sheet looks like. So there's not a surprise. And the second is because the banking system is safe, sound, and resilient. And we have remedies in place that solved parts of the crisis and the stresses. So I think we're coming in, it's the same thing when you have the rise in yields. We're doing it against a strong economy. We're doing it against a strong, a solid banking system. So that just means that the ripple effects are not going to be tipping things over. The fragility is not there, right? It's a sound system. And then you have this. And so then you have it able to absorb the tension points.
One thing that there's been a huge debate around is the long and variable lags. And this really speaks to this question of all of a sudden, if you think that 10-year yields are at 5% rather than 4% or 3.5%, that changes what implication there is into different business models. How much does it change the business model of commercial real estate owners, of different residential real estate owners, of some of the constituents who you speak to on a regular basis?
So I'm going to separate, that's a terrific question, but I'm going to unpack it into 2 parts if you don't
Please.
mind. The long and variable lags and how are people reacting to that? And I just met with a variety of commercial real estate CEOs with national footprints on Monday, so I can bring some of that to this conversation. But let me start with the long and variable lags part. So definitely there's always a debate. If you want to really get into debate, get a PhD in economics, and you'll spend a lot of time if you're in macro debating long and variable lags of monetary policy. So here's what we can all agree on. There are lags and they're variable. And then people even debate about how long are they? But I go with long and variable lags. And the question is, we know that from the Fed's communications to financial markets went quickly. And then the question is, how long does it take to get through the economy? I'm of the view that we're still seeing the effects of that. We saw it initially in housing, then we started seeing it in investment. Now we're starting to see it in, the labor market and inflation, et cetera. And so it's absolutely happening. And we want to continue to watch that because we're with the risk more balanced on the economy. We could as easily, I think at this point, overcorrect than undercorrect. And that's why taking the time to do it right is sort of where I think we need to be. Now, on what I'm hearing in this rise in yields, they have been less concerned, at least my commercial real estate roundtable, less concerned about the lags in monetary policy as much as this. There is this time when people were in, one person described it as sort of it's almost like a foot race, right? But it's not really, it's really just like I have to see if the Fed will cut rates before I have to refinance my properties. And so you're in a look ahead and you're saying, well, if the Fed cuts rates, like the market suggests they will, market suggested 6 months ago, early in 2024, or at least by the middle of 2024, then by the time I refinance, I'm golden. But that equation changes if we're higher for longer to get inflation down, or if the yields are just going to be higher, well, then projects that penciled out at near zero interest rates or something much lower, they don't pencil out at 5. And so I think one of the things that we think a lot about is what's the switch point for commercial real estate, because you really want that to be an orderly repricing. And so far it has been, rather than a disorderly one. But I think that's a risk worth watching, is that these higher yields change the psychology of what's possible for people, and they start making those adjustments immediately, as opposed to in a timeline that goes with the refi schedule.
Just to build on that, this idea of 5% or 4.8 or 4.7% of long-term rates that's being increasingly priced into markets, how much does that imply a significantly greater degree of distress in some of these areas, like real estate, commercial real estate, that rely on this idea of refinancing 5-10 years down the line?
I think we have to, and this is one of the things we're going to have to do just as a nation, is if we are in a higher interest rate environment in general, and I don't think we should jump to the conclusion that that's where we are. I think we should have a conversation. Is it going to be the low interest rate environment? Are we going to have a nominal neutral of 2.5, or is it going to be something higher? Are we going to be fighting inflation from above our target now for a persistent amount of time, or is it going to go back to fighting it from below our target? We don't know the answers yet. So I think what I was really important is commercial real estate owners and purchasers and things, they have to be willing to play the longer game, right? What's the longer game look like, and how do I get to the longer game? And I'm hearing this in the San Francisco CEO roundtable. Now, again, these folks have a national footprint, but I'll share what I learned is that, they're already tranching their properties. If you've got really high quality stuff, you're putting all your work in terms of leasing into that property, and there are deals to be had. So people with income to use, they're buying those properties up, because property ultimately in buildings are valuable down the road. If you have property that you think isn't just in the world of higher interest rates and lower okay, I'm going to go back to the land value, and I'm going to not try to spend a lot of time leasing that property or wait it out, and I think that's the repricing we're going to need to see. We are just going to need to digest some of those losses and position for the new world. The yields going up, I think it doesn't change that dynamic. It just brings people's awareness sharply to the problem, right? You could have seen the problem coming, and I think many did, which is why I'm not, I don't have alarm bells ringing. Commercial real estate people, they just tell me this all the time, and I have learned to believe them. You really have to have a strong constitution to be in commercial real estate, because it goes through cycles. And the way that the successful ones persist is they recognize that the down point isn't forever, nor is the high point. So they get used to it, and they stockpile, and they refi early. When they see interest rates going up, they're trying to put stuff into longer maturity so that they can not have to refi at the higher interest rates right away. So I think that's going on, but that is a sector to watch, as all of us know. And this will be just another piece. The higher bond yields will be another piece that makes the scrutiny have to be more intense.
To connect that to the idea of financial distress, people talk about a Fed put. How high is the bar for the Fed put? How high is the bar for financial distress, for the Federal Reserve to come in and to cut rates and to take actions to add liquidity to the system? How much higher is the bar at a time where inflation is still running at the levels that it's running?
So I'm going to separate these two things. I think they get pushed together all the time in a way that I don't think about them. So I want to separate them. So there's monetary policy that's about the two goals that Congress gave us: full employment, price stability. And we raise and lower the funds rate to do that work. And because this all gets conflated more easily because we have a balance sheet policy. So we use the asset purchases for two functions: market dysfunction and quantitative easing, right? To put additional policy accommodation in when we hit the ZLB. So we have both, but they can actually persist separately. So let's take the BTFP. The BTFP didn't change monetary policy. We went in, we saw some stress in the banking sector with the backstop from the Treasury, opened the BTFP facility, helped calm the banking stresses, and monetary policy went on. And I think that's the way you should think about it. So I unpack those things. I hear a lot about the Fed put and this. What I really would do is, we have tools that can be used, and the tools we use for financial dislocation are different than the tools we use for monetary policy, and both can occur. So we shouldn't have to give up our promise to the American people, our commitment to achieve our mandated goals and bring inflation back down to price stability because we have some dysfunction in the markets. But I right now don't see dysfunction. What I see is prices have gone up for bond yield. Prices have gone down. Yields have gone up for bonds. The 10-year now and other rates look similar to what we might have penciled in the SEP for how much we were going to hold rates higher for longer because of the inflation. And I think they'll respond as the data come in to. I think markets have a better sense now, although I can't be sure of this. I don't want to say things that I don't have certainty about. But it seems there's a more of an understanding about the Fed's reaction function now. And big part of the reaction function understanding that seemed to be missing was that we want to get inflation down to 2%. And in our forecast, we don't see it coming down to 2% like that. And in order to keep it coming down to 2%, we have to keep rates restrictive in order to bring the economy more into balance, the labor market into balance, and inflation down to 2%.
That's San Francisco Fed President Mary Daly speaking with Bloomberg Surveillance co-host Lisa Abramowicz at an event at the Economic Club of New York. We've got more of that conversation up next. I'm Charlie Pelletan. This is Bloomberg. You're listening to a special conversation with San Francisco Fed President Mary Daly at the Economic Club of New York with Bloomberg Surveillance co-host Lisa Abramowicz. Let's listen in to a bit more of their discussion on the Fed's path forward.
You talked about vigilance and you talked about agility. And with respect to agility, you wanted to be able to tweak policy according to what you're seeing in markets. And one thing that people have been speculating, and I'm sure this is sort of one of these theoreticals that make you roll your eyes. Goodness.
I never roll my eyes.
Well, I will say, when people talk about what you said in your speech, which is that as inflation falls and as growth slows, that the policy rate, even by not moving, by keeping it steady, is a policy action. And it is actually tightening policy. At that point, how agile should the Fed be to make adjustments to the rate so that the restrictive level is the same, that might be lowering rates, but not because of financial distress, not because of some sort of recession, not because of weakness?
So that's a terrific question. And I would argue that we're now entering into the hardest phases of policymaking, right? The hardest part. So I think of phase one is the one we completed. We completed it earlier this year. Rates are too low, inflation's too high. There's only one direction, north. So everybody can agree. There's nobody's confused. It's just a matter of how quickly can you get to restrictive territory and without causing any concerning disruptions. So we've accomplished that. Phase one. Phase one was the easy phase. You just have to communicate. We're going that way. Inflation will come down. The biggest concern that I had during that phase one, well, I had two. How fast can we go without distressing things? And two, how will we communicate that we're doing that? Right. Those were the two things I was worried about. How fast can we go and how can we communicate that so that we don't lose credibility? Right. So because I was worried about the inflation expectation. So that's down. Phase two is fine tuning where we maintain the peak rate. And then phase three is trying to bring it down to 2%. And so right now, the way it's penciled in the SEP, if the inflation forecast holds, and the inflation forecast you see more generally, policy is growing more restrictive. So you might ask, well, why? Well, I think it's because it's challenging to get that super core inflation down. We've got the easy ones behind us, right? Goods inflation's already come down a lot. Housing inflation is in train. We have to keep watching it. But that super core is going to need persistent work. But if we saw, and the labor market's strong, we're doing this against a very strong labor market. We'll see tomorrow if that persists. But so far, pretty strong, solid labor market, good consumer spending, good GDP growth. I mean, there's nothing about the economy that's faltering. So, but if that should change, well, then of course we could adjust rates so that we keep a level of restriction right for the economy we have. I don't really want to try to tell you what that's going to be, because honestly, that's what the whole speech is about. We have to tolerate our uncertainty of not knowing what it's going to do next year, but to know what elements we have and how would we react to whatever situation unfolds. Ultimately, humans hate this and markets hate it more. Nobody likes uncertainty, right? They want to know, we all want to know exactly what's going to happen. But I think right now, projecting too confidently what will happen is actually a policy mistake, because then you end up with surprising people and things. So I think it's really important that we stick to conveying our reaction function, conveying how we trade off and balance things, how we approach the uncertainties. And then as we get more information, as everybody does, then we'll of course see what to do next.
With respect to the actual economy and what's going on and what you see going on there, you talk about the labor market and how strong the labor market is. And I know you've done an incredible amount of research in economic inequality and the worker and the labor market. Through that lens, how do you view some of the labor strikes? What's going on in Detroit? What's going on with respect to the Kaiser Health systems? What's going on with just the Hollywood strikes, which are sort of resolved, but maybe not?
So I think, the picture of the labor market is broader than just the strikes. I think the strikes get a lot of, because they're big labor actions, but in general, we've seen a rebalancing of the labor relationships with firms. That is a very common occurrence in an extremely tight labor market, right? Their demand for workers is outstripped supply of workers. That means that workers would have more power to say, I want to live here, do this, have this other thing. So workers who aren't in unions and don't have regularly scheduled negotiated contracts, well, they can make those adjustments more continuously, right? So I'm sure you've experienced this too, but if you were an employer in 22 and even late 21, you really saw wage demands rise, special circumstances. I want to live in here and work in there, and I don't want to come back to the office. A lot of changes in how workers were relating to their employers. And there was also a relative demand shock for low wage workers that, moved restaurant workers and hotel workers to delivery drivers and other things. So that whole work situation was changed. I see the labor actions that have been taken recently is they're on regularly negotiated contract schedules. And those schedules came up and they say, well, a lot's changed since we negotiated the last contract. Pandemic, wage rates have risen. We have not been in continuous negotiations with you, and we want to get in a better negotiation with you to ensure that we have some shared responsibility for the rapidly rising inflation and rapidly rising changes in the contours of the labor market. So to answer your question, I think this is completely predictable given the imbalance we've had between demand and supply for workers. And there are going to be some renegotiations either in continuous space, like we have been seeing, or when contracts become up for negotiation and you have to renegotiate the terms of employment.
What's the difference between renegotiating the terms of your employment and a wage price spiral?
Oh, that's a huge difference. So I love that kind of question. Fantastic. Okay. So
I'm straight.
Labor renegotiations I'm looking at, what I've had to put up, what I've had to deal with as an employee. A lot of it is I've got this wage and inflation's going up this, so my real wage is falling. That's something that was commonly happening in 22 in the United States. Real wages were falling for many, many groups of workers, many tiers of wages. And that's something workers recognize, right? They recognize when their real wages are falling. They're losing purchasing power. They're falling behind, even though they're earning. So that is what a labor negotiation is. It also could be like in healthcare and things, hours worked, terms of trade, schedules, et cetera. A wage price spiral is that people get wage growth and then firms selling pass that along to consumers. That causes inflation to go up. And then they see that inflation and they ask for wage growth. And you see this high correlation. A fact that's worth looking at, it's a very cool plot because it tells you why we're not in a wage price spiral right now, is prior to 85, the correlation between wage growth and price growth was like 0.85. That broke down after the Volcker disinflation, and it really is now like 0.25, 0.3, et cetera. So you don't have that one-for-one pass-through of wages to prices, prices to wages. It just doesn't work that way. And even now you see wage growth moderating. And I also look at short-run inflation expectations. Short-run inflation expectations are coming down. As they come down, research out of the San Francisco Fed has shown, and others have confirmed this, that short-run inflation expectations are what people are using when they go in to negotiate wages. And so as those come down, you get release of wage pressure. So the worries about wage price spiral people were worried about it in 22, and we took that very seriously. We asked how that was going. At this point, those have really abated. And now we're really at a point about getting the wage growth rate to be balanced in the economy, bringing the labor market into balance, adding you need about 100,000 jobs per month to keep pace with the labor force growth. At the last call, we were at 150. So tomorrow's labor market report will tell us whether we've made more progress on that space or just sort of in that same place we've been in. But that's how it's different. They're completely different. One keeps me up at night. One is just a natural part of an economy.
So I love that when we were speaking ahead of this, we were talking about anecdotal data. And I said, I love that you study the sociology of markets, and anecdotes are really important. As you said, I don't view them as anecdotes. They're qualitative data.
I think I said it that way.
You did. And you corrected me. You said, absolutely not. I wouldn't call it anecdotes. It is qualitative data. What is the qualitative data or the anecdotes that the conversations you're having?
Here's why I don't call them anecdotes, because anecdotes are like I talked to Bob in the grocery store. And then I know everything. That's what, people trade anecdotes all the time because they heard one person, two people, four people at a party say it. At the Fed, the regional Fed presidents in particular, I think it's one of the big benefits of having a regional Fed. When the folks who set this up set it up, I think they thought this would happen, and it does happen, is the regional Fed presidents and the entire regional Fed teams, we're in our districts collecting qualitative information by talking to many people like you, having roundtables, et cetera, but then we write it up. And so the difference in an anecdote and qualitative information is we quantify the qualitative information. If one person says it, it does not mean it's the thing we should take on as fact. But if 50 people say the same thing, well, that's an early warning sign, or some flavor that helps us, flesh out what the aggregate data are telling us. And what the qualitative data are telling me are really, there's many things, but I'll tell you a few. So at the beginning of this year, I'd say most of my conversations, when I asked them, what's your biggest concern? They said recession. Then it switched to stagflation. They thought we were going to have high inflation forever, just low growth like we did before the pandemic. And now now I say, what's your biggest worry? And this is really remarkable. They said, well, I'm really worried about generative AI and how it changes my business in 10 years. I'm really worried we're not educating our population enough to keep pace with the jobs we are creating. So why am I focusing on those? Because those are longer term concerns, which means the anxiety they have about their short-term business has gone down and is being replaced with the things that really should keep business leaders up at night, right? How is this going to transform my business? Do I have the workforce I need, not today, but 5 years from now, 10 years from now? What do I need to do in my communities to ensure that we're durable? So that has been a sea change. And then when you drill down, like with commercial real estate leaders, of course, they're thinking hard about, okay, I've got this property. What's the future? But their attitude, it was really interesting across the board. It doesn't matter what position they're holding, is they say there are going to be losses, but there are going to be opportunities. And what I'm trying to do in my business when I went around to each of them is say, I'm trying to minimize the losses and maximize my ability to see and take the opportunities. And so I see that as a positive change in the environment we're in. And it's why, I said in the speech that the recession fears are being replaced by soft landing. Soft landing is, just in their description, something that happens that doesn't break the economy and bring all their attention to how do I manage through a significant downturn. And I am not seeing that when I take the temperature on that. I'm seeing instead they're talking about these longer term issues that they're grappling with.
Does that mean that they're hoarding labor, reluctant to cut jobs, because they do have this expectation that even if there is some sort of slowdown, there is going to be a brighter future ahead with not as many qualified employees available to do the jobs that need to get done?
So I have the benefit of having done this work for a while. I was at the Fed long before I became the president, and I've been a labor economist my whole career. So I would like to broaden that part out just a tad. So it is very common when employers go through big shocks that carries over into their behavior. So let's go to the fact that in the financial crisis, employers had to cut nominal wages. They hate cutting nominal wages. They because it demoralizes employees, et cetera. So that had a long tail. They had to fire a lot of workers, right? They had to let go. And they, for a lot of employers, if you're not the very largest employers in our country, you're letting go of people each and every member of your team, and you had to let those workers go. And then you had to cut nominal wages. It's extremely painful. So then they hired extraordinarily slowly and kept working people overtime and other things just so they didn't have to be in a situation where they would have to let go of workers should another shock come. So now what I'm seeing is the opposite of this. In the pandemic, people lost workers because they were afraid to come to work, or they decided to take early retirement, or they moved away. And so now employers are like, oh gosh, I better keep people. So I think we have to put certain amount of this behavior we're seeing to that. But the other part is, and this is another benefit of doing this for a while, I think, is another part is that the way it works in most cycles is that the very first thing that happens is hiring slows. The second thing that happens is layoffs occur. You don't have a lot of firms laying people off before they slowed their hiring. So when I'm looking at metrics for what I think is happening to the labor market, I'm looking at hiring statistics, job filling rates. You might have postings out there, but you're not filling. And what I'm seeing is a general slowdown, but not a cliff. But obviously, if there was a significant downturn, then businesses have to resize. But we're not seeing that yet. Even the layoffs we've seen have come in the tech sector, where they got a little bit ahead of themselves on growth and then had to rebalance their workforce to meet the actual growth they were going to have. So I don't see anything out there that is ringing an alarm bell about the workforce. And people say labor hoarding. I kind of think of it as we're just always fighting the last war. And you fight the last war of, we had to lay off a lot of people. You don't want anybody new. You fight the last war of, oh my gosh, I lost a lot of people. You hang on tight. We're also in a very tight labor market from the employer's perspective. It's loosening, but from an employer's perspective, they still have to spend a lot of their time finding workers to replace workers who leave, or if they want to open a new slot, that's expensive. So they definitely want to hang on to as many people as possible.
I have to open it up to questions in a second, but I do want to just ask you this before I do that. What do you think right now is the biggest misconception about the Fed and how they're operating policy?
Well, I don't know if it's the biggest misconception. I would love to hear what you all think the biggest conception is, so that I could, tell you whether it's an actual misconception or true. But I think one thing that I've seen people say is, and it's just interesting. So we always have vigorous debates. That's what you should expect from us, that we vigorously debate and discuss. People are we all come from different backgrounds. We use different lenses. We have different information. We talk to different people. We have different research teams. So of course, we're all bringing it in, but we're all working towards the same goal, which is, what's the best policy we can make today that will serve the goals of achieving price stability and full employment? That's what we're doing. When we were in the pandemic, if you look at the dot plots and things, it looked like there was a ton of agreement. Well, of course there's a ton of agreement. The only thing we can do is lend support to the economy. Then when inflation's 7%, there's a ton of agreement about what we should do with rates. Not surprisingly, inflation's way off our goal. We have to raise rates. Now we're going to start to see a little more dispersion in the dots, but that is not because we suddenly started debating and suddenly started disagreeing with one another. It's because the situations around us changed, and we've always debated and discussed and things like that. But now the policy projections change because people have a different projection about how they see the economy unfolding. And yet we all come together 8 times a year and make a policy decision. And I see that as the real strength of the FOMC. It's one of the reasons I've worked at the Fed as long as I have, is because when you close that door to the meeting, there's no politics, there's no ego, there's just, hey, let's try to figure out what we're going to do that's best for the American people, and how do we do this well, and how do we stay vigilant and agile.
That's Mary Daly, president of the Federal Reserve Bank of San Francisco, speaking with Bloomberg Surveillance co-host Lisa Abramowicz at the Economic Club of New York. For more conversations like this one, subscribe to the Bloomberg Talks podcast. I'm Charlie Palatin. This is Bloomberg.